All right, so quickly, I'm going to plug this analyzer in for tomorrow. So this is we'll call this the quick version, right? We have now we've eliminated a number of pages. We have page 1, which is the summary. We have summary and assumptions. This is where a lot of your data points will be entered. And then you'll have your breakout, which will be provided by all the data you plug in on page 1 and page 2. So you will not input any data here. This is just a breakout of your terms. And then lastly, that's the monthly. This will be your yearly all the way through. So it's gonna make it a lot cleaner for you to see. And this is gonna break out everything on yearly. And then lastly, disclaimer, right? So page 1, here's a cool thing. You now have the ability to create a 1-pager for your property when you have a deal that you want to put out to your investors. So on this sideline here, you're going to put in the metrics that you're trying to hit for your deal. So if you're looking for investor returns of 14, investor multiples of 2, cash on cash without the sale of 8, and average annual return with the sale of 17, you'll plug those in. What will happen is that, okay, this deal that's in here now does not hit these, but if we went back in here and let's say we put a 10 IRR, a 1.5 multiple, and a 12 average annual return, it will highlight those down here in green when those metrics are shown. But what you can do here is you can now write an investment overview. So this is, 123 Main Street in, wherever we just were in Knoxville, Tennessee. It is a 32-unit opportunity in the heart of Knoxville, a growing submarket with a ton of upside. The property has been mismanaged, yada, yada, yada. Here's a picture of the property. Here's the asset type, the purchase price, renovated basis, total units, square footage. This will all be pulled off the second page. This all will go out here. You can print this page and put this in your packet and now give it to your investors. It's going to show this will be 5-year hold, 10-year hold, wherever it would be. Here will be the returns, unlevered, which most everyone here is always going to be levered. But if it isn't unlevered, that's what it would look like. Levered. The exit cap, which will be a certain there. Gross exit value price per unit. This will be the net returns to your investors. And hypothetical, this is how returns will look on a 100-unit or $100,000 investment. And this is cool. This also will show them hypothetical on what the returns would look like if you were to sell month or year 3, year 4, year 5, year 6, year 7, year 8, yada, yada, yada. Here, down here, you can also talk about some other information you can add on here. So this will give you the ability here where you can send a 1-pager out to your investors when you have that deal that can basically talk about your acquisition date, if the financing, your interest rate, your loan, your amortization. If you are going to refi, that can be played in here. So this will be really cool because now it's a plug and play. Each time you have a deal, put this together, send this out to your investors, and it can be a nice entry point so you can go from the mock deal status to have a template to have a real deal status. So the only things you're going to touch are the blue, right? So here, I'll keep it standard. We're going to be looking for a 2, an 8, and a 17, right? So this deal at this price point where we have this in here does not hit those metrics. If it did, it would highlight them in the investor returns. So that's it. All you're going to change in this first page is what target metrics you are trying to hit for your investors. Only thing. Again, nothing will be changed monthly. Nothing will be changing annually. This will be where the meat and potatoes right here. You can literally just go straight through here, follow all of the blue data. Now, a couple cool things we added. If now you have a loan and that loan is maybe whatever bank and that bank is requiring reserves. Well, now you have the ability here, you will put in your reserve requirements, whether it's on the debt side over here, debt service requirements, tax requirements, or reserve requirements. Now, here is the point. The reserve requirements, you can also say Now, is this yes that they're going to be released back to investors as capital, or if you're going to keep them in your pool for money to be allocated to the property? And if you don't have reserves, you just put zero. So this is one of the things here that's going to be highly beneficial, because instead of you having to guess how to put the reserves in and how they're going to be allocated later, we add in a feature here where you can show the reserves being held for whether it be 12 months or 6 months or 18 months. Hopefully this doesn't last so long, but now you have the option to do that. Another cool addition here is that you have the loan to value or loan to cost option. So if you go in there for a construction loan, or you get something where it's 70% loan to cost on the loan and the rehab, you can now just toggle this down to loan to cost, right? Or toggle this back here if you're just bringing the CapEx to the table, and that will transition your loan amounts. Again, if you are bringing capital as the GP sponsor, you're bringing 10% of capital, then this will show that you'll be 10% of capital. If you're not, and the investor are bringing all the capital, then you will be at zero. So this will be information you're going to plug and play in the property. Acquisition will be allocated as last day of the month. So if your assumption that you're going to get a deal under contract, you're going to close in 75 days, then you're going to close September 15th, this in October, in November 30th, right? So November 30th, put November 30th, 2020 in there, and then you can allocate your hold based on where you want. Your distribution would then be set up. When would you start distributions, right? So is this a heavy value add where you don't assume you're going to add distributions to, month 12, or will you start this now month 3? Talking about your loan, you can plug in all of your loan details here all the way through and what you assume your fees will be. And if there is a prepayment penalty, what that payment penalty will look like going through. These will be our acquisition costs: purchase price, acquisition fee. A lot of states don't have this, but if there's transfer taxes, this would be what the transfer tax would be. Your due diligence, your cost there, your legal fees, and this could include not only your loan for your lawyer, for your closing attorney, but could also be title, could also be syndication attorney right there. Reserves that you're going to hold for yourself beyond the requiring reserves, and then other closing costs that may align with the property. So it gives you a lot here where you can work to really put in these numbers, but you're going to plug and play, and some of this here will roll over. So your acquisition fee may stay the same for deal to deal. If you're in the same market, your closing costs may stay the same. Your hurdle rates may stay the same, right? So, you may be just a 70-30 split up to 8, and then after that becomes 40, 50, 60. So the more you perform in a deal, the better you get. So after a 20% IRR, the more split that goes back to you, right? Depends, of course, how you break out the deal, right? So you may just have one waterfall here that it's 30. So a lot of it, what we do is we do 30, 30, and then it's 50, 50, right? So that's our waterfall, just to keep it basic. So you can get more involved or less involved. Here will be your preferred return. That will also be a point. If you want to do a 6 preferred return or a 7 preferred return, you have the option to navigate that as well. And some of the cool parts here is this is going to be all of your T12. So just take the items you have off that income statement, plug them in all the way straight through, income and expenses. And if they don't align, leave them at 0. And down here, this will show you here what these prices per units are. Down here, you're going to make your assumptions on your growth. If you find you have a big delta, year 1 for gross potential rent, you may be able to take this up, 5% in year 1, but then you start planning off at 2% throughout. If this area warrants a 5% vacancy, but you're trending at 10 or 12, or you're doing a lot of rehab or a lot of turnover, maybe you'll be at 10% in this year 1 here. So you can push in there. And then the cool thing that we did leave in here is you can blank this out here where you can give this a bulk item number of, for your unit schedule for variation, where you can just, if you're just thinking I'm going to have $3,500 per unit, item number 1, you can just leave it item number 1 and just put in $3,500 a unit for interior and $2,500 for exterior. But if you are able to get more in the weeds here and you start having a better idea of what's going to be spent. Like I need 50,000 for roofs, and I did this. Then you can start breaking these out as line items here. So roofs, windows, replacing plumbing, parking lots. This may be cabinets, flooring, whatever, lighting fixtures, painting. So you can start breaking those out as on a line item for those. Where that's going to come in handy is up here. You'll plug in your units and 1 bed, 1 bath. You may have 1 bath, 1 bed, 1 bath, unrenovated, 1 bed, 1 bath, renovated, right? So there may be 24 and 24, and then you may have 2 bed, 2 bath, unrenovated, 3 twos, unrenovated. You'll look at these renovated units in place right here, 2, 5, 7. So you can tell how many are renovated, and current in place rents and current market rents, current renovated rents. So this gives you what the rents are for the units that aren't renovated, for the units that are renovated. And you can say how many units are you going to schedule for renovation, which is pretty awesome, right? Because now you can say, we're going to do all the unrenovated units, and looking at our rent roll, we're only going to be able to do about two per month, but really we're not going to be able to start till month 4 or month 6 or month 8. So it gives you the ability to put in there, instead of assuming that day 1 you're going to use all that money, you may say that it's going to take us 2 years to renovate all those units. Right here, it takes 2 years, a little bit over 2 years. So now you can be more realistic based on the data here to keep it in a narrative where all the money doesn't look like it's getting spent on day 1. But again, you don't have to go this far into the weeds. You could show it as just that you're showing this if you want to just get a high level overview of the property just on day 1. But this will give you a part where you can plug and play on one page. It gives you more opportunities to do a little more damage with the numbers here than you could be doing before. Does that make sense?
Jason, just a comment.
Sure.
I really like the fact that you included the sensitivity analyses on the right there, investor returns versus exit cap rate. That was actually something that I saw as a shortfall of Michael Blanc. He does a great job with his underwriting analyzer as well. But that was one of the things I always kind of wanted to have.
Good. And one thing the only thing I have a little bit all over the place, but I think it just falls in line here, is the fees, right? So acquisition fee, disposition fee. So you're buying the property, you're selling the property, and then asset management fee is really going under expenses here because it's part of the deal. But again, you can see here with the sensitivity analysis that Mark was really relating to here is that, okay, I want to do a 10-year deal, but is that the best for the play right here? Is it worth it for me to get here? I almost double the money here. It's like another whole 100K back on the investment right here from here to here. Is that worth it? Well, it might be, right? But I look here for these cap rates. If I'm wrong and the cap rate's actually a 7, where's my downside on this deal, right? So if I'm at here, and it's a 1.65 multiplier, and here it's 1.36, right? What does this do to the investor profit? So to here, right? So it takes it down pretty dramatically, right? So if I'm off even more, and this is going to change. Let me think what happens here. So this now changes, right? Across the board here of where this goes off the whole period, right? So they actually just went down dramatically here if I change this exit cap. And there, so 6. Oh yeah, so here it does. So 8. So yeah, so it'll move you in the needle here where you'll be, right? So there's where it shows you, and here's where it shows you where you'll be out. So it does, let me see. So usually I think we cap, it doesn't change 9. I forget how far I had them go. Yeah, so it pushes off the level right there.
It's also probably a good idea to include with investor presentations. I think it might reassure investors to say, this is the universe of likely outcomes. You know, we don't know
Yeah, this is
ultimately
good
where.
for the investor packet as well, right? So we got room to grow here, right? You know, so in that part, um, you know, like we got room to grow because if this deal, if we were off on our data points and the world turns over and we exit at you know, traditionally this market's been a 5, and but for so be it, we range out to a 7. The deal still has muster on it. It still beats, you know, historical returns in the stock market or other. One part to note: if you get here, you toggle on yes. This will put this on for you. So this black box gives you the opportunity to go in here and do a refi as well. So I'm going to put this in there. You'll have the full-fledged analyzer in there. This will be the quick analyzer. The full-fledged has more tabs, is more detailed out. But what this will give you is a month-to-month, how the months look as you break out. So you get a better sizing about, you know, how year 1's doing, how year 2's doing, how in year 3 you should be performing. So it's just not an overall holistic view. And then you'll get in here to your yearly, and this will show you across the board what your hold looks like throughout. And then down here we'll start breaking out returns as LP returns, and then deal level returns. So this will be deal level returns, what it will look like here, and then the LP return. So deal level right now, you know, 1.78 multiple, 15 IRR. LP investors, 13.2 investors. Now here's the promote, right? GP returns post promote, boom. Put money in, 2.9, you know, not bad. so pretty good little deal for the operator right there, as long as it helps, as long as it makes the investors some good money. Questions? My point here would be take a deal, run it through, and we can come back on some next ones here, and then go through this again. The key points here to take home with this is this gives you the opportunities to put in more loan segments besides just a standard loan to value. Gives you the opportunity to do refi if you want, has the opportunity to add reserves, and whether or not, some of the question right now is, what do we do with these reserves? Do we play the level where we don't need this money right away, so we're going to take this money and reuse this money as part of our capex later? So in 12 months, we'll just take this money and reuse it, or is this money that goes straight back to the investors? Because doing that, you know, yes or no, can series out show you how different returns will be to investors, right? So it will show you exactly, okay, if we hold this money in a deal, this will do this. If we keep this money and give this money right back to investors, it will do that. And then playing around with the sensitivity level, and then looking at sizing up how you're going to look at your opportunities, right? So what are going to be your key points? 14 IRRs, you know, multiples, cash and cash returns. Where are going to be those sticking points? But it can give you a part where you can start prepare your deal summary for your investors, so you're ready. So that's going to be a nice spot right here, because this again shows you, boom, what your deal will look like. All right, makes sense?
Yeah.
Awesome. Awesome. This will get you ahead along the way that you can go in here and get a little familiar through this and use this to fly through deals and really just do some damage, because now you're playing on one page and you're not jumping from page to page. And if you give me 1 sec here, I just want to make sure I'm telling you the exact thing with the release. This should be. So yes, if you, for the reserve part, if you put it as yes, though, that when that is done holding the reserves, it will get released back to investors. If you put no, it will imply that it will get used for capital improvements. So that's just a point for there. Maybe I'll make it a little more clear in there. But just make note here is that under the reserves, if it's yes, it's release means it's going to get released back to your investors at the timing, right? So the 18-month. And why we did this is you assume that maybe you're not going to meet the debt coverage service ratio by month 12, and maybe you got to hold it to month 18. If you assume you're going to get back at 12, then you get it back at 12, and then that money would go out. So if it was a no, let's see where we're at here. Just want to look real quick. 13.23. So how would that? So here. So it just changed the deal, right? So we're using this for CapEx versus returning the money early. So if you look here, and right now, here's how much it can change the deal. At a 6 cap, investor equity multiple 1.59, IRR 11.56. If we use it for capital expenditures, but at this time period here, month 18, if we give them back that money, well, now it jumps up here to what? So return of capital is massively important. How quickly capital comes back to people, right? So knowing how your reserves are used is huge in terms of importance right now. So you can look at that and really play that into your investments to say, okay, how can I be most proficient with this money that's in reserves? Cool. All right.